I, Nivedita Tulsiandri, scholar at School of Management, NIT Rourkela, welcome you all to the fifth day of our FTP titled Earthwise Transforming Climate Action and Sustainability for Better Tomorrow. I am honored to warmly welcome Mr. Deepak Kumar. He is an accomplished risk management professional with over 15 years of experience at the intersection of finance, sustainability, and climate risk. Currently, he serves as the head of the ESG cell at Union Bank of India, where he leads transformative initiatives in sustainable finance, climate risk integration, and ESG reporting. His extensive background includes the development of robust risk frameworks, policies, and models, particularly in the domain of climate stress testing and climate modeling. His academic pursuits of doctorate in sustainability and climate risk further demonstrates his commitment to advancing both industry practice and academic thought. Having held senior leadership roles at Corporation Bank, where he spearhead key project on Basel guidelines and IFRS 9, he is recognized for his expertise in ESG risk, credit risk, and operational risk. Sir's work reflects a seamless blend of practical experience and forward thinking vision in driving sustainability within the financial sector. We find our privilege in welcoming such a distinguished personality. We welcome you, sir.
Yes. So thank you. Can I start now?
Sure, sir.
Yes. So thanks everyone for inviting me for this session. So I don't know really deserve that kind of introduction or not, but I am a student in this subject. Myself a student. So I'm currently pursuing doctorate in sustainability and climate risk. So I'm in two areas. One is related to reporting standards and frameworks, and another is related to impact of climate risk on cash flow of corporates. Okay, and have with background in risk management, and then when I started taking care of ESG and climate risk, so I will tell you that why this subject is very different from the other subjects which we have till now read, or which in which I have been working. So I worked in uh, risk management for last more than 15 years and worked in credit risk and market risk, operational risk, and all other risks. Uh, the difference here is that in climate risk, so the models, the working, everything is changing very dynamically. So since the start of Paris Agreement, so a lot of changes has happened. For in credit risk, so whatever document which we go through, including the model validation related guidelines, so most of these guidelines are 20, 25, 30 years old. And in fact, for market risk, we use in banks generally we use value at risk. So in fact, that model was built in 1980s, and it has got still its relevance and in some adopted form. But with climate risk, so the things are very much changing. So each country is contributing in some or the other way towards this fight, and we are seeing that each year COPs are happening, and those targets are getting revised, and finance acts as a major role in this climate change. So I will be focusing my entire side of sustainability and climate risk and overall ESG related concepts, and how as a financial firm we are using that into our practice. So to start with, let me tell you a brief background that so first of all, let us differentiate between what is ESG, what is sustainability, what is climate risk. So I understand that this is, I think, fourth or fifth day of your webinars. So just to reiterate, so sustainability is something which we is a practice which we use in which we use resources judiciously so that it remains for use of future generations. So sustainability is something which is very wide, encompassing everyone. So whether it is companies, individuals, so it's a kind of thought process which can be applied anywhere. And ESG is something which is very much applicable for companies. So ESG stands for environmental, social, and governance, and there are different things which we consider under ESG. So I've got a particular slide on that. And then climate risk is something which is very specific. So it's basically impact of uh, greenhouse gases, which is leading to the increase in overall global temperature, and which is leading to different types of risks for firms like us, which includes physical and transition risk. So this is a very specific topic under the wider gambit of environmental, social, and governance. Okay, and coming to the developments which has happened in India and in abroad. So we are aware about Paris Agreement in 2015. So different countries, about 190 plus countries, decided to restrict the global temperature rise to 2 degrees Celsius, and then they have fixed an aspirational target of 1.5 degrees Celsius. And with this, countries started adopting certain targets. India has adopted target of 2070, China has 2060, and then these targets percolated to corporates. So corporates have also started adopting these targets, and then came the beginning of disclosures. So TCFD was the first disclosure which has come up, and which is now rebranded as ISSB. Then GRI was one which was there earlier, and we have got newer versions of that. So Global Reporting Initiative, and SASB was another reporting standard which was earlier used, which got merged with ISSB. So these were some international developments which were happening. Then coming to capital markets, so SEBI has come up with guidelines related to BRSR, and then we have got guidelines related to ESG rating providers also, which has come up. Then coming to financial sector in particular, so from RBI side, in the beginning, in I think 2022, there was a discussion paper from RBI on climate risk and sustainable finance. Then RBI came up with a green deposit framework. So based upon that, a lot of banks have found a product named green deposit. And then RBI also came up with draft disclosure frameworks for climate risk, which is based on the lines of TCFD. So TCFD basically stands for Task Force on Climate Related Financial Disclosures. And there are 4 pillars under that. So we will be looking at that also during today's presentation. So these are governance, strategy, risk management, and metrics and targets. So RBI's thinking is based on that line. So I will be also touching upon that during in this presentation, that how RBI's thought process is different as compared to SEBI, and what needs to be done to sync those. So that also I would be touching. And since I am a student myself, so I would be also, since all of you are into research field, are into teaching field, so there are very interesting use cases which are developing, which are very fertile ground for doing some research. And you can identify based upon your priorities those topics also, and then continue research on this topic. So then coming to the developments within the bank. So basically how banks are tackling this is that, so they are developing some sort of ESG governance structure in the bank. So in terms of governance structure, most of the banks, including us, have got a board level subcommittee which is dedicated to or which looks after ESG related matters. So in addition to some other requirements, then there is an executive level committee in most of the banks, so which consists of the top level executives, which is fully focused on ESG related matters. And when ESG related matters are discussed in banks, so basically there are 2 aspects here. One is the own operations part, and the other is the portfolio part. So when it comes to the own operations part, so what is happening in the bank with relationship to its employees, overall its governance structure, then bank's own emissions, water related, waste related practices. So all these are considered under bank's own operations related part. Then coming to the portfolio part, so when bank onboards any customer, so what kind of ESG related considerations has to be done? So that is one part. And then financed emission, which we would be seeing in the later slides. So how that has to be taken into decision making process, although it is at initial stage only. So that is also I would be covering. And then overall, what is how physical risk and transaction risks are impacting banks portfolio. So that I will be covering. So I understand that till now you must have understood what is meant by emissions and which are the different types of emissions. So just a quick recap of that. So there are three scopes in that. So scope 1, 2, and 3. So scope 1 is direct and 2, 3 are indirect. So scope 1 is basically emission which occurs in own premises or own machineries or whatever which is owned by the organization. So for example, as a bank, the emission which occurs in our own vehicles or own diesel generator sets. So those are our scope 1 emission. Then scope 2 emission is the emission which comes out of purchased electricity. So that is scope 2. And scope 3 is all other emissions, whether it is upstream activities or downstream activities. So for example, employee commute or capital assets or different other expenditures which are happening. So those come under scope 3. But one which is very important for banks is scope 3 category 15. So there are different categories of emissions. So category 1 to 15. And category 15 is very important. And it is in fact, so there are some estimates which tell that category 15 emissions are 700 to 900 times more than all other emissions in a bank. And that comes from our own lending and investment portfolio. So that also we will be covering. So basically, banks follow PCAF methodology for their finance emission. So PCAF stands for Partnership for Carbon Accounting Financials. And in fact, our bank is one of the first major banks to become signatory to that. And then also how banks integrate climate risk and ESG considerations in their decision making is through various reports. So environmental social due diligence is one requirement which has come up recently. So what banks do is that for any big project loans, so they conduct environmental social due diligence, and they use that in their decision making process. Then ESG scorecard and physical risk assessment. So this also we would be covering. And there is a new concept which has come up, which is related to biodiversity and nature risk. And in fact, we have also started some pilot works on that, but it is still in nascent stage. So this is the entire gamut of activity which we undertake under ESG and climate risk. So whether it is related to policy or measurement. So now moving to the next slide. So we will be going now deep into the various activities, that how we are actually doing that, and which are the things which are work in progress as of now, where still a lot of research needs to be done, and banks have not yet started using those into decision making processes, but have started quantifying to some extent. So I will be going into those details also. So now coming to ESG rating related criteria. So what ideally banks need to do is that, so banks generally follow credit rating models. So in the traditional credit rating models, banks generally use financial related parameters, business related parameters, management related, and industry related parameters. But ESG related parameters are not exclusively captured. So although there are a few data points, and in fact in management there are a lot of governance related data points, but they are not exclusively captured. So now recently a trend has come up that banks have started using separate ESG scorecard. So they take data points related to environment, social and governance. So environment basically means data points related to climate change or emission related data points, water, then waste related data points. For social, human capital related data points, then relationship with vendors, and then governance related, how corporate governance is happening in those companies, conflict of interest. So these data points, they exclusively look for companies, especially for listed companies and bigger corporates, and they are developing a separate scorecard for that. But still, it's a work in progress, and there is no clear-cut methodology that whether that scorecard has to be some add-on to the existing credit rating, So it should so there has to be some notch up or notch down strategy in that, or it should be a separate scorecard altogether, and then this can be viewed independently. So there is no clarity on that. And also there is, in fact, there is one beautiful study which was conducted by MIT. So what they did was that they compared credit rating of different credit rating agencies for different companies, and then they compared ESG rating of different companies by different ESG rating providers, and they found that almost in 99% of the cases, so credit ratings are matching from different credit rating agencies. But in about only 60% of the cases only, so ESG rating of the companies from different ESG rating providers are matching. So by different ESG providers, I mean, so companies like MSCI, Sustainalytics. So only in about 60% of the cases, this was matching. And this is mainly because each one has got different weightage, different sets of parameters. And also, so there is one very unique comparison between ESG rating and credit rating. So when we consider credit rating, so uh, we have got dependent variable there. So there our target variable is defined. So target variable is the default event. So if uh, if any rating model is able to predict default in a better way, so then that rating model is considered as a better rating model. And if the default increases with deterioration in the credit rating, so that model is considered to be good. And there are different tests for that, like for example, KS, Gamma, Petra index. So there are different statistical tests for that. But in ESG rating, so there is no target variable. So sometimes some people use uh, financial performance vis-a-vis ESG rating and try to compare that. But that is not a target variable. And this is also a good area of research in which people are working to, so trying to find out some relationship between ESG rating and then credit rating. So in case if you are interested, so you can think on this topic. Now coming to the emission part, so this we have seen earlier. Basically, just to recap, so scope 1, 2, and 3. Scope 1 is own premises, own operations. Scope 2 is the purchased electricity, and scope 3 is upstream and downstream activities. And for banks, scope 3 is the major activity, and in that, the investment is the major source of scope 3 emissions. Now, this is the finance emission measurement formula. So, and this has been taken from PCAF, which is Partnership for Carbon Accounting Financials. So, this is a global organization, and this was initially promoted by a few banks from Europe, and then a lot of banks have become member to that. So, in India currently, we were the first bank to become member, and now 8 banks have followed us. So, what basically it does is that, so it identifies different asset classes. So by asset classes, I mean that corporate loan is one asset class, or business loan, then project loan is an asset class, mortgage loan, vehicle loan. So it identifies different asset classes, and then uh, gives the methodology to compute finance emission for that asset class. So till now they have given methodology for 7 asset classes. So these asset classes include listed equity, then unlisted equity, then business loans, project loans, mortgages, vehicle loans. So, and how this works is that, so let me give you one simple example. So for example, if 1,000 rupees is the amount which is used by a company in its operations, and out of those 1,000 rupees, if 300 is its own equity and 700 is from debt, then out of that 700 which is from debt, 400 is the share of our bank, 300 may be share from other bank. So I'm just taking a hypothetical example. And then if that company is producing 1,000 kg of CO2 equivalent emission, then in that case, so since in that entire 1,000 rupees which is used in that company's operations, which is has been invested in that company. So our share is 400 rupees. So out of that 1,000 kg CO2, so our share would be 40%. So that is 400 kg of CO2 would be our share. So in case of reporting scope 3 emission, which is financed to that company, so we have to report 400 kg CO2 as share of our emission. So that will be our scope 3 category 15 for that customer. And the same way it is computed for all the business loans. Then in terms of vehicle loans, so this is estimated based upon how many numbers of kilometers any vehicle has run. So based upon that, and in similar way, it is computed for home loans or mortgage loans also, that what is the electricity consumption or estimated electricity consumption. So that's the basic way in which it works. So there is no rocket science here in this computation. Okay. Then coming to the beauty of PCAF, that how flexible it is. So, for example, if you take Tata Steel as a company, and if that company has computed its emission, its scope 1 and 2, and it is verified by some third-party assurance provider, for example, maybe KPMG, then in that case, so it will be considered as the best data point, and it is considered under 1A. And there are different data quality scores which PCAF provides. So that can be considered under 1A, and then the data quality score deteriorates. So in case if Tata Motors or Tata Steel, in case if Tata Steel has computed its emission but it's not verified, then it will be 1B. So similarly, the other level would be that if it has not computed, but we know that what is the electricity consumption of Tata Steel, then we can compute that. So it will be the next level. Now, if we do not know that, and at least we know that what is the amount of steel which Tata Steel has produced, then we can use emission factor for that production unit, and we can multiply with that and arrive at that number. If we do not know that also, and we know that what is the revenue of Tata Steel, then based upon that, there are emission factors which are available for per unit of revenue. So that also we can use that. If we do not know that also, and we know assets, what is the asset of that company, so based upon that also we can do. And if we do not know, we simply take the loan outstanding, and we take sectoral what is the emission for that sector, and we multiply with that. So what PCAF expects is that, so banks can start with score 5, and for listed corporates, so bank can go for a score 1 or 2 depending upon whether it is assured numbers or not. And then over a period of time, the movement from lower data quality score to a better data quality score should happen. So that's the basic purpose, and that's the flexibility which has been given in this methodology. Now coming to the next section, which is related to the climate risk type. So I hope you are aware, but just to reiterate, so there are two types of climate risk. One is physical risk, and another is transition risk. And physical risk is again divided into two types. One is the chronic risk, and another is acute risk. Chronic risk is something which happens all of a sudden. So for example, flood or cyclone. And acute risk is something which occurs over a period of time. So sea level rise, or precipitation changes at a particular location over a long period of time. Then coming to transition risk, so there are basically this risk arises on account of movement of economy from a carbon intensive economy to a less carbon intensive economy. And there are different types. So policy and regulation related transition risk can be there. Then technology related transition risk can be there. So policy and regulation related, so generally the example which everyone quotes is related to carbon tax. So basically this is the tax which is put on the emissions which are produced by any firm which has not yet started in India. And then there are technology development related transition risks. So for example, so from internal combustion engine vehicles, we are moving towards EV. So that is a technology transition risk. Then consumer preferences also is another transition risk, wherein consumer may be looking for more sustainable solutions. So, for example, EV is one example. Then many people are turning towards vegetarian, considering emissions under poultry or uh, emissions under poultry. So these kind of consumer behaviors may lead to transition risk for different firms. Then overall, so it can have impact on household also and on businesses also. In terms of impact on household, it can impact the productivity because of, for example, during summertime, because of heat, so a lot of productivity will get decreased. Then loss of household income can be there, and then impact on property value can be there. And in terms of businesses, the impact can be on damage on account of physical risk, then stranded assets on account of physical risk as well as transition risk. So basically, stranded assets are assets which which may not be of the value for which they have been procured or which were earlier considered, on account of change in the overall environment or on account of damage to that asset. So those are considered as stranded assets. And then in terms of macro also, so climate risk is having a huge impact, and that's why most of the countries have now started incorporating, and they have become very serious about this. So including supply chain, inflation, overall productivity. So it has got huge implication. And then interaction of climate risk with different risks. So what happens is that climate risk doesn't act alone. So it amplifies the for a financial firm. So it amplifies the impact of other risks. So for example, it can increase credit risk on account of higher number of defaults, or market risk because of change in the equity or bond value. And for operational risk, it can because of climate risk, because of physical risk, there can be disruption. So these are certain examples of linkages of climate risk with traditional risk which banks have been, financial firms have been catering to. So overall, these were the different risk types. So now we will be moving towards each of these risk types. So what is happening currently in banks, what kind of methodologies which we are using for these risks, and what how it is a very dynamic process, and what kind of expectations we have for this for the model to develop, and the things to evolve. So basically, whenever we are talking about any measurement related activity for climate risk, whether it is physical or transition, so we have to consider three things in mind. So first one is what is the hazard, then what is the exposure, and then third one is what is the vulnerability. So by hazard, what we mean is that, so for example, for physical risk, so chronic and acute are different types of hazard. So whether we are considering flood, cyclone, drought, so these are different types of hazards. Then for transition, policy related changes or technology or customer preference, so these are different types of hazards. And then what is the exposure? So in financial firms, so exposure is the firm or the portfolio which we are looking to evaluate. And sometimes we may have granular data also in terms of the location of asset. So that may be the exposure. And in terms of vulnerability, so how vulnerable it is. So for example, there is some company which has got lower emission for production of steel as compared to its rivals. Then in that case, if there is some carbon tax which is coming from Europe on the emissions which are getting produced in their imported steel portfolio, so then that company has got lower vulnerability as compared to its rivals in that sector. So similarly, if some company's particular asset or factory is located at a higher point, or it has implemented flood protection measures, so in that case, the vulnerability of that exposure is less as compared to vulnerability of other factories which are there in the vicinity. So these are certain examples of vulnerability. So overall, whenever we are talking about any risk and we are trying to measure any risk, uh, 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 any impact of climate risk on any company or any asset, so we need to consider these three aspects. What is the hazard which we are thinking? What is the exposure here? And what is the vulnerability? Then we would be going deep into this topic. Now, coming to physical risk drivers and the different data-related complexities. So, as we already talked about, so it talks about uh, three uh, uh, three factors here. So, hazard, exposure, and vulnerability. Then, in terms of exposure, so we need to have detailed location of asset. So, in India, what we currently have is PIN code level vulnerability index for physical risk, which has been published by CEW, which is Council for Energy, Environment and Water. So so that information is only publicly available. Then there is no other public database which is available even at PIN code level. And the most precise information or most precise measurement will be happening at latitude and longitude level. Then in terms of vulnerability, so what will be the impact of different vulnerabilities? So that needs to be assessed. So in terms of data related challenges, so there are a lot of variability in the prediction precision of hazard. So for example, for flood, there are certain models which can predict flood at 5 meter by 5 meter dimension. But those kind of models are not available as of now in the Indian context. Uh, but there are a lot of public models which are available in the global context, and a lot of paid models are also available in this regard. So similarly, uh, at asset level, we need to have different levels of data points. So, for example, if any asset is there, so whether it is a factory or warehouse, or it is a residential building, or this is a commercial building, then what is the type of asset that is, whether it is concrete or whether it is a tin shed. So that kind of if detail is there, so then it's better. It's more uh, uh, it's easy to predict the kind of impact which will be there from different types of hazards. Then when it comes to using different climate models, so basically they have got different uh, different time horizons. So mostly what we have seen is that for climate models, they are very long term in nature. So when it comes to predicting something in very short term, so for example, what will be the probability of flood at a particular location, and what will be the damage because of that flood? So that is that then the accuracy of those models are very low. Then the most important problem which banks generally face, and for which a lot of companies are currently working, has come up with solutions, is that uh, is finding the relationship between the scientific models and the financial impact of those. So for example, if there is a flood of 50 centimeters in a particular region over a period of 2 days, then what will be the financial impact of those models? So that kind of analysis is not easily available. So a lot of startups have come up, a lot of insurance firms, which has mostly reinsurance firms, for example, Swiss Re and Munich Re. So these have worked earlier also, and they have got very good models to predict that, to relate flood risk and or any physical risk, for example, and then the impact, the financial impact of that. But in India, what we are seeing here is that the kind of data sharing or the kind of data pool which is required from the insurance firm, so that is not available as of now. And because of that, so whatever models which are available and which uses any financial information are generally adopted from the developed countries only. Then these are the vulnerability indicator scores for power-related subsectors. So this is just an indicative. So how different vulnerabilities are identified for different subsectors under power. So the same way it is done for different sectors and subsectors also. So when we talk about physical risk, so generally the notion is that physical risk is going to impact any particular factory. So we need to do for that. But ideally, as a financial firm, so what we need to see is that what is the entire value chain of that company, and what is the impact of physical risk on that. So it can include impact on its natural resources, how energy is supplied to that, then any supply which is climate sensitive, uh, its transport routes also, that how raw materials are getting are reaching that factory. So for example, if there is no flood in the factory but there is flood in the transportation route, so that is also going to impact the production of that company. So we need to see the entire value chain of any company while doing this physical risk assessment, and that that will be able to tell a better picture as compared to only restricting the study to a particular asset level, to particular factory level, or to particular collateral level. Then these are the different types of risk which we or different types of factors which we cover while we assess the financial impact. So what will the direct impact? So on the operations and assets. Then in terms of indirect impact, what is the indirect impact of physical risk on the supply chain of any factory or any company, and impact on the market also. So for example, if some company is producing something which is to be used in some market, but that market gets flooded and people are not having that purchasing power to use that product. So these are certain examples. Then adaptation costs. So for example, climate proofing and climate adaptation, resilience related whatever cost which company incurs. Then it has got impact on the revenue also. So any disruption is going to impact the revenue of the firm. So in fact, what we have seen is that there are certain models, so which give two types of output. One is the loss in terms of asset value, and the other in the number of days for which disruption will be there. And how banks generally do is that, so then they stress the cash flow of that firm, and then they try to understand what is the vulnerability of banks interest income on account of stress in the cash flow of that firm, on account of impact on the revenue of that firm. So these are so this is a very important slide, and this tells basically so overall that so this is a summary of whatever we have done till now, and this tells that how physical risk scenarios can be enacted and how it can be used in the decision making process. So basically, so there are different scenarios which are there in the physical risk. So for example, RCP is a scenario. So there are RCP, SSP, NGFAS, integrated assessment model. So these are certain models and scenarios which are there. So I'm not going deep into this, but how this work is that they try to assess that under different temperature increase scenarios, what will be the impact of physical risk or transition risk. Okay, so under these scenarios, for example, less than 2 degrees Celsius, which is Paris aligned, or net zero 2050 later scenarios, 2 degrees Celsius scenarios. So how the physical risk will get impacted. Then there are different time horizons. So for example, 2030, 2040, or there are certain models which give prediction till 2100 also. So what is the time horizon which we are seeing? Then we need under the different scenarios, we need to understand different hazards. So for example, acute events will be happening over a longer period of time. So for example, in 2050 or 2100, and then chronic can happen in near term in 2030 also. Then there are different levels of analysis. So whether we have to do it at asset level or firm level, or at sector level, or at portfolio level. And then what is the impact which we are trying to assess? So whether it is macro environment or supply chain of any firm, or operations and assets of that firm, or its markets or consumers. So that we need to see. And then, so what kind of method which we are deploying? So whether we are seeing the physical exposure or vulnerability indicators, or we are trying to assess the financial impact using some financial impact modeling. So that we need to see. And then while when we conduct scenario analysis, so the important factors what we require is that uh, what is the location of that collateral or that asset, and whatever supply chain related activities are there. So what is the location, exact location? What is the value of that asset or value of that supply chain related activity? And what is the characteristic of that assets? For example, whether it is factory or commercial building, what is the type and build of that? And in terms of output, so there are models which give some range of output. So for example, some score like between 0 to 1 or 0 to 100, what is the impact? And then they classify that into very high, medium or low. And there are certain models which give impact in terms of financial metrics also. So for example, what will be the impact in terms of percentage of loss in the asset? So climate value at risk, we tell that. So there are some models which are able to give that also, and there are some models which are also able to give that for how many days number of days the production will be getting impacted. So this is the overall uh, summary of the physical climate risk assessment scenario which we conduct generally in a bank. So then different data and tools. So most of this I have already covered. So in terms of climate models, so there are different models. So for example, RCP, SSP, then International Energy Agency has also got its own models. Then NGFS, so Network for Greening Financial System. So they have got very good models which are hosted on their website. And then hazard map is one important requirement. So we need geospatial data for that. Then there are certain asset level databases and impact models which are available. And finally, the financial modeling platforms, so which will be able to predict what is the economic impact of these hazards, and that can be used in the decision making process of the bank. And there are a lot of different challenges in these, a lot of data gaps also. So for example, I talked about availability of granular data for different assets, then geospatial hazard information. But things are going in the right direction. So a lot of agencies are working. In fact, RBI has also told that they will be coming with a climate risk information system where they would be providing physical risk database, which can be used by anyone who will be assessing physical risk. Okay, but there again, that will not be very granular. So that will be at max at pin code level. So in case if we have to work at latitude longitude level, so we need to subscribe to something which is not there in public domain, which are private databases which are available. Then these are certain predictor variables and certain financial indicators which are used for two sectors. I have given just an example while assessing financial impact of physical risk. So, for example, for real estate sector, so what is the what is the impact on local amenities and economy? Then what is the type of property characteristics? Then in terms of financial indicators, what is the delinquency rate or loan denial rate? Similarly, for agriculture, what are the farmer characteristics? So what is the holding size? And then in terms of financial indicators, what is the crop area, yield, value, what is the delinquency rate, and what is the economic risk profile? So these are certain factors which translate the physical impact data into economic impact factors. So, but most of these informations are already built into these models. But also, this is also work in progress, and there are very few work which has been done by some not-for-profit organizations like CEW or CPI or GIZ. And this is one area which requires a lot of research. Then there are a lot of advanced statistical techniques which are getting used for physical risk modeling. So hedonic pricing model is one which is getting used, and it is used mostly for isolating climate factors in asset valuations. Then there is a concept called difference in difference analysis, which measures impact of a specific events. So this difference in difference is used in those. Then Ricardian analysis is another model which is getting used, and EBT, machine learning. So a lot of approaches are already being used, and a lot of new approaches are coming up in this sector. So this was all about physical risk, which we have seen till now. Now coming to transition risk, so there are different. Factors for transition risk. So policy related factors. So for example, carbon tax is one policy intervention. So, and which is generally most common factor which we use in terms of scenario analysis for transition risk. Then technology assessment is another factor. So what kind of low carbon solution can come for that. Then overall, how market is going to behave, which are the reputational related factors, then customer preferences. So all these we use in the transition risk modeling. Now coming to the transition risk factors which we generally use. So carbon pricing is the main factor which we generally use. So and that can vary. So for example, in some cases, some organizations which have already disclosed, so they take $10 as the carbon pricing, but there are certain organizations and certain geographies who will take carbon pricing in the range of $80 to $120 also. Then shift in energy mix is another important factor which can be considered. Then energy efficiency requirements. So there are different mandates in different sectors. So for example, this energy mix shift and energy efficiency requirements are very important in hard to abate sectors, wherein government is coming with a lot of regulations. Then there are a lot of low carbon products which are coming and which are competing with traditional products. So EV is one example. Then also, so there are firms, for example, coal or oil and gas related firms, which faces a lot of issues related to pile up of stranded assets. So the kind of valuation which we use, the models which we use, for example, FCFF or FCFE. So all these models, whatever we use. So in these models, so right now, currently, we do not factor climate risk related factors into these models. So what we need to do is that from scenarios, we need to understand that what will be the utilization of those resources. So for example, for coal or oil and gas, and how from what time they would be becoming stranded assets, how their utilization is going to become low, and then what will be the financial impact on the cash flow of that firm. So those also need to be incorporated in the models. So there is some work which is already going on, but it's an active area of research which you can look upon. And this is related to again, so what will the impact of direct cost and indirect cost in the transition risk. So in terms of direct impact is change in the carbon price times scope 1 emission is the direct impact. And in terms of indirect impact, there can be change in the cost of energy and other non-energy production inputs or supply chain related issues. Then the other impact on company can be on account of increase in exposure or incremental investment which is required on account of procuring low carbon technologies. So for example, in terms of steel, there is a huge requirement of low carbon technologies, and there is a huge demand of capital also for that. And the other aspect which we see while modeling the impact on any firm is related to revenue, that how revenue is going to get impacted, what is the kind of product which company has got, what is the kind of product mix which is there at present, in future how that product mix is going to change on account of change in the customer behavior or overall transition to a low carbon economy. And so overall, what we try to identify that what will the adjusted net income of any company on account of changing revenue, then incremental low carbon capital expenditure, and incremental emission costs. So this is overall how we do transition risk assessment. So basically, when we consider incremental direct emission costs, so what we need to see is that how large an impact because of the emission cost on the different production segments of any company. And basically, we see that what is the current emission intensity of any company, and what will be the impact of incremental direct emission cost. So for this, the analysis is the carbon intensity of production is the main factor which we use. Then the other risk factor which we consider is incremental indirect emission cost. In this, we see segments supply chain which is likely to become more expensive because of climate policy and based upon its mix of different inputs. And for this, we need to understand that what is the input output analysis for that company. And there are different databases also which are available for that. Then what is the incremental low carbon capital expenditure? So when we move towards a low carbon economy, then what will be the incremental investment which will be required in new fixed capital cost and additional operating expenses to run that that additional fixed capital. So what is the additional cost for that? So there is one mathematical formula, and that is also an area of research. And in India, a lot of firms are working to identify for each sector what is the marginal abatement cost curves for each sector. So this is an active area of research, and a lot of work is happening on steel and cement basically, and for other sectors also it is happening. So basically, what the researchers are trying to identify is that for what is the additional amount of capital which is required to reduce the emission. So that is known as marginal abatement cost curves. Then what will the impact on change in revenue on account of product mix or on account of change in demand? So, and there are different factors like industry price elasticity of demand which are considered for this. Then for different sectors, so at high level, if we have to prepare a heat map, so this is how it looks like. So it's just illustrative, which we have developed, which we I think this was adopted from UNIP 5.1 report, but this is just an illustrative, and each organization needs to develop their own heat map depending upon the type of customers they have got in their particular portfolio. So basically, when we do prepare any heat map for any sector, so we look at these four factors. So what will be the direct emission cost for any sector? What will the indirect emission cost? What will be the low carbon capex? And what is the impact on overall impact on revenue on account of change in customer behavior or in product portfolio? So this process of preparing heat map is the just starting point, and this is this is an intuitive exercise which people generally use, but there are mathematical models also which can be used here. Now coming to the complexity which is here, so now for banks it becomes complex because climate risk has got an amplifying impact on the traditional risks like credit, market, operational. Then again, so what we generally do is that physical risk and transition risk we measure separately, but they are also interlinked, and that interlinkage has not been studied yet. Then climate risk has got systemic nature. It is linked with overall economic stability, and it has got potential of climate induced financial contagion. So from that aspect also it needs to be seen. And then there are other linkages also. So for example, linkage related to liquidity risk, then linkages with geopolitical and macroeconomic risk factors. So these are also very important factors which needs to be seen when we have to think of climate risk and its interlinkage with different financial risk. Now, to summarize this, and when we conduct overall climate stress testing exercise, so what are the factors which we generally see here? So when we see, so what we generally see is that portfolio. So what kind of granularity we need to see, whether it will be at a sectoral level or it will be at counterparty level. Then what will be the economic resolution of that, or what kind of spatial data we have got, or what is the temporal resolution. And also, one very important aspect when we consider about transition risk is that whether it is top-down approach or bottom-up approach. When we do bottom-up approach, especially we do bottom-up approach for bigger corporates. So at each corporate level, we have got very highly granular data points. So we do bottom approach. But when it comes to portfolio, then we follow top-down approach. And then using these, so what we generally do is that, so we fix first our time horizon, what is our short term, what is medium term, and what is long term. So generally accepted short term time horizon is 3 to 5 years. So 2030 is the ideal short term horizon. 2040 and 2050 is the long term horizon. But for physical risk, 2100 is also considered as long term horizon. Then what we need to see is that especially from transition risk point of view, that what kind of balance sheet approach which we have to see, so whether it is static balance sheet approach or dynamic balance sheet approach. So in static balance sheet approach, what we assume is that the balance sheet as of now will remain as it is for the time horizon for which we are predicting. There will be no change in mix of that balance sheet. But in terms of dynamic balance sheet, what we generally we assume is that whatever incremental cost of expenditure, whatever expenditure is there, or whatever revenue is there, or total assets is there. So all these are getting impacted because of climate change or incremental investment in low carbon capex. So all these are getting impacted in the balance sheet, and then the financial factors also get changed over a period of time. But it is very complex, and there is one paper from HKMA also, Hong Kong Monetary Authority, which gives detailed insight into how it can be done. So they have given a beautiful model to work on that from HKMA. And then the other considerations which we need to do is that whether we need to consider insurance into this or not. So these are certain factors which we need to consider while doing climate stress testing exercise in a bank. Then overall, so data limitations, challenges we have already seen for physical risk and transition risk related. So in fact, for transition risk, the biggest challenge is the assumption which has to be taken for carbon tax. Then the model uncertainty is another challenge, and there are limitations in the climate models, and they are not yet proven, especially from transition risk point of view. In fact, from physical risk point of view, the models are mostly proven, although the financial impact of those models are not yet proven, but the science side of the models are generally proven, and especially for factors like cyclone. So there are a lot of good models which are available. In fact, there is an entire research field called catastrophic modeling. So this started in 1990s, and a lot of reinsurance firms like Swiss Re and Munich Re, they have developed a lot of beautiful catastrophic models. So these are known as CAT models, and they have matured enough. And floods also, there are very good models which are available. But for transition risk, the availability of models is not yet mature, and it's still a work in progress, and it will remain in work in progress for next maybe at least 3 to 5 years. Then from regulatory point of view, so still there is a lot of clarity which is required. So till now there is no guideline on climate risk stress testing, but I am aware and I have been part of those discussions when climate risk stress testing draft guideline was getting developed. So what I can say is that draft is ready; it can come anytime. So it climate risk stress testing guideline from RBI and disclosure guidelines, final disclosure guidelines for which draft has already come. So those would be coming anytime. So these were the things related to physical and transition risk scenarios related to physical and transition risk interlinkages. Now, I will just touch upon disclosure requirements, and then what is happening across the world on the disclosure side, and where we are lacking in that field. So TCFD, you might be aware, just to reiterate, so TCFD stands for Task Force on Climate Related Financial Disclosures. So it was formed in 2015 and it gave its report in 2017. So this gives its recommendations under 4 pillars, and basically governance, strategy, risk management, metrics, and targets. So basically governance talks about how climate risk is to be managed. So TCFD is fully on climate risk. So there is no dilution, no ESG, no sustainability, nothing related to that. So only climate risk is discussed in TCFD. And another beauty of TCFD is that, so whatever CSR, you might have read a lot, CSR related activity or ESG related things, which you might have heard, or BRSR related data points and all. So what is difference in TCFD is that in all these CSR related or BRSR related or GRI related, so in all these things, what is the impact of company on the society, on the environment? So we generally talk about that. So for example, if company has spent something on, for example, 100 crores in CSR activities, so how it is changing the community. So that impact is getting measured or is getting shown in different beautiful reports. Or in terms of BRSR, so how much emission is happening, or how air quality or waste management is getting managed by the company. So all these things get discussed in BRSR. Okay. But the beauty of TCFD is that it talks about what is the impact of climate change on the cash flow of the corporate. So from the going concern point of view, so how that impact will be that its cash flow gets impacted. What will be the worst case scenarios? So for example, in scenarios they talk about that under 2-degree scenario, what will be the impact on the cash flow of that firm? What will be the impact on the profitability of that firm? So considering climate risk, how an organization can change its strategy, or how it can change its different product mix, how it can change its planning. So basically it talks about how climate risk is going to change the strategy of that organization. So that is getting discussed here. Okay, so it has financial materiality is one thing, but from the impact side, so it is very important that it overall talks about the impact on the firm. And from financial point of view, so why it is very important is that ultimately as an investor, what we need to understand is that by studying any disclosure, whether it is financial or non-financial disclosure, that what will be the valuation of the firm in which I have invested. So basically TCFD aims towards that to assess, so it helps the investors in assessing the impact on the valuation of firm on account of impact of climate change. So basically governance talks about roles and responsibilities of board and different top management. Strategy talks about how climate risk is integrated into its financial planning, what is short-term, medium-term, long-term horizon, then overall strategy, and then how firm has conducted scenario analysis and how scenario analysis is integrated into its decision-making process. Then in risk management, generally it talks about which are the different risks which firm has identified, then how those risks are, how different climate risk has been identified, and how climate risk integrates with or interacts with different traditional risks in an organization. And for metrics and targets, so which are the scope 1, 2, 3 targets, then what are the targets which has been fixed by organization to manage climate related risk and opportunities. So TCFD is not only talks about the risk part, it also talks about the opportunity part. And what is the expectation here is that overall, so this should not be working in silos. So these pillars should be integrated with each other. Governance is the overall pillar, and then this strategy, risk management, and metrics and targets. So all this should talk to each other. So metrics and targets should be based upon analysis of or reports from risk management, and then that should also form a part of overall strategy. So this is the overall objective of TCFD. Now there are different international reporting standards. So I have excluded GRI here. GRI I have excluded because so GRI talks about overall ESG, and ESRS is another European standards, European Sustainability Reporting Standards. So that also talks about on the line of GRI. But here, if you see here, so the expectation here in most of the reporting standards, so this is SEC proposed draft which has come up. So that is not yet finally implemented, and may not be implemented for next 4 years. Okay, so basically what it talks about is that, so in terms of expectations, it expects that along with financial information, this information has to come, this disclosure has to come, so that it is a tool for investors to use this information in their decision making process. Then the other important thing is that scope 1 and 2 everyone talks about, and scope 3 is one thing, so which is also there in common in all these three. Then intensity matrix is not asked per se in ISSB, but it is there in ESRS and SEC. And overall, if you see, so all these talk about empowering investor in using the disclosures in their decision-making process. Now coming to integrating climate risk with credit rating. So this is just one example which I have taken from S&P, and Moody's also does almost the same thing. So in this example, what I am trying to say here is that so when S&P does any assessment of any company, so first they do assessment which is without taking any impact of climate risk related impact. Then the other assessment which they do is that they take different key drivers related to climate risk. For example, what will the impact on price, volume, or unit cost, capital expenditure, all this, and then impact of this on the company level, income statement, balance sheet, then cash flow, and then overall. So they arrive at some term called what is scenario adjusted credit score and PD. So for example, if for some firm if PD is 1.35%, so under scenario adjusted PD under net zero 2050 target, so the PD can be 1.50, 1.35, it can go to 1.50, and in 2 degrees Celsius it can go to 1.75, and in 3 degrees Celsius it can go to 2.5 or 3 degrees Celsius. So that's the number which they arrive at, and that's the end result which banks are also trying to achieve. So by trying to achieve, what banks would be doing in future is that, so this is also one of the expectations from RBI and the regulators across the world. So what they expect is that banks would keep capital for that, so that incremental whatever change in PD is there, change in probability of default is there. So for that, banks are expected to keep capital for that. So although this is a nascent at nascent stage, it will take some time for this to develop, but that's the ultimate goal towards which banks are working. Now, this is the final slide. After that, we will be taking questions and answers. So, this is in this we are trying to summarize the different types of ESG and climate risk assessments which happen in the bank. So, if you see the left hand side, uh, so we talk about ESG scorecard. So what is expected is that we should have ESG scorecard, and that scorecard can be different for different sectors and can be different for different types of customers. So, for example, for listed entity, there is a lot of public information which is available, so we can have very granular ESG scorecard. For unlisted corporates, we can have a smaller version of that, and for MSME, we can have some basic ESG scorecards. Uh, and there are different ESG data providers, for example, Refinitiv, Bloomberg, ESG-DS, so they are there. And then banks would have ESG scorecard, which can be used for front book as well as back book. So by front book, I meant to say is that whenever any new customer is getting onboarded, so at that time also this ESG consideration has to happen. Then whenever we are revalidating any loan, so we generally call that as review renewal of any loan. So at that time also that ESG scorecard can be used. So this aspect is related to only ESG related. The other aspects, whatever we will be seeing in this slide, in this particular diagram, is related to climate related aspects. So then it's up to bank how they are trying to integrate that with their existing credit rating models. So it can be notch up or notch down approach. And then overall, what will the impact on the rating of that customer? So this is, and one of the inputs under this can be also the finance emission for this. So this is this was related to the ESG related portion. The other section is on finance emissions, which is major major building block of bank's climate risk related whatever work which bank does. So for this finance emission, we have seen the PCAF methodology, which I have shown you in the earlier slide. So that's the basic starting point. And there are a lot of publicly available databases also, uh, which we generally have data for listed entities. And then we have got emission factor related databases for different kinds of activities, which can be used for arriving at financed emission. Then at customer level, we need to identify what are the location where customer is operating, which are places of production, which are our collaterals, what is the supply chain of that customer. And then we need to arrive at physical risk uh, assessment of that customer. So there are different physical risk data providers also, or it can be done internally based upon publicly available databases also. Then at customer level, we need to understand what is the transition risk of that customer under, especially under different scenarios. Under NGFS has come up with different scenarios. So that is a good starting point. And there are different complex scenarios also which are available, which can be used by the firms. So overall, when we look at these transition scenarios, physical risk impact, then what will the impact? So overall, we conduct climate stress test using this under different scenarios, and then we try to assess that what will the impact on PD, that is probability of default of the customer, and then loss given default of the customer. And accordingly, we need to take that into consideration while assigning capital for any customer or for any portfolio. So that's one aspect. Then the other aspect which has got huge implication is the risk and opportunity part. So from opportunity part, we this can help banks to identify that, for example, based on physical risk, they can identify that which are the geographical areas which needs to be avoided, which are the geographical areas where exposure can be increased. Then in terms of transition risk, they can identify which are the sectors which can be avoided and the sectors which can be where exposure can be increased, which are the emerging sectors, or within a sector, which are the areas, for example, for steel and cement. So there can be a lot of opportunity because of the transition. So that assessment can be done. And so this can be linked with overall risk appetite statement of the bank. So by risk appetite, I am not only referring to the risk, so also from the strategy point of view, the opportunity related requirements. Then the other important aspect where this whole exercise leads to is on the reporting part, which we have already seen in TCFD when we talk about metrics and targets, risk management, and strategy. So in strategy, in terms of scenario or in terms of financial planning, in terms of risk management, linkages of climate risk with other risk, and in terms of metrics and targets. So this is very useful. Then the other very important factor which we need to look after is related to the decarbonization plan. So as we all know, that country has a decarbonization plan of 2070. So in that decarbonization plan, so as a bank and as the custodian of capital, we have got very important role to play uh, by moving capital from carbon intensive sectors to low carbon intensive sectors. So then we need to assess that for each customer, what is the decarbonization plan, and for us as a bank, what is our decarbonization plan. So if 2070 is the decarbonization or net zero target of the country, so our target can be in the range of 2055, 60 or 50. Then to achieve that target of 2060 net zero, as a bank, what is the contribution which we need to make. So by making contribution, I mean to say that what is the reduction which we need to make in terms of emissions. So for each customer, what is the pathway that they are taking and where that pathway is. So there are different international agencies which has also come up with sectoral pathways. So Science Based Target Initiative is one such agency. So where that company's target is vis-a-vis science-based targets, or vis-a-vis bank's decarbonization plan, or vis-a-vis country's decarbonization plan. So once we are able to understand that, so then we can sit with that customer, we can understand their requirements, we can see what is the opportunity for us in terms of financing their capex or opex, and we can understand what are their apprehensions in terms of the markets to which they serve, the kind of risk like CBAM which has come up in Europe, and we can guide those customers in this journey. So this is the overall work which is happening in a typical financial organization like us. So most of the things which I have talked about here is basically a work in progress. So most of the things we have just started doing this, and we might not have matured at that level, but this will take at least 5 to 10 years for this particular subject to mature. So now with this, I will end my presentation. I'm open to any question.
Thank you so much, sir, for such an insightful session. Dear participants, we can take your questions in the chat box as well, and you can unmute yourself one by one and ask sir directly your questions.
Hello, sir. Namaskar.
Namaskar.
Sir, can you put some light on purchase power parity with some basic example?
So power parity in the context of what you're
During discussion, you touch a word like purchase power.
okay. Okay. So for example, when we do finance emission measurement, so we generally follow some databases which has been developed in Western world, and which are maybe dollar denominated or euro denominated. So for example, in PCAF, we use those databases which has been worked on the assets or revenues which are euro or dollar denominated, and they have been developed in 2019. So when we are using those, so we need to convert those numbers by adjusting inflation and the currency conversion factors also, so that they are more real in the Indian context.
Thank you.
Okay, any other question? I'm not able to access the chat. So in case if someone has put it in the chat, so can someone please read that?
Sir, Alok sir has put a question and he himself asked it right now.
Okay.
Hello, sir. No one is asking, so again I'm.
I have a query.
Sir,
Yes.
I am actually, this is my confusion. What I am understanding about RCP, if just I'm taking one example, RCP 2.0, and I'm taking example of time horizon like 2030 or 2040 and
Hmm.
2 degree. Then what I'm getting ki till 2030 we have to stop like temperature. Like currently, if I'm taking about example 49 degrees Celsius, then we have to stop till 2050 on 51. Yeah, we have to reduce 2 degree, like 49 to 47.
Okay. No. So how RCP works is that let me explain you. So basically, uh, uh, sunlight comes to earth and then it gets radiated and then some portion of it gets absorbed, and because of this by greenhouse gases, and because of this heating happens. Okay. So now there are different assumptions under different RCPs for different amounts of this absorption, and because of this there will be different impacts under different time horizons. Okay, so when we consider time horizon under RCPs, so we do not mean that if we take 2030 as the horizon, time horizon, so we do not mean that by 2030 it will be reaching that. So because of this heating, so what will be the impact by 2030? So that is there. There are scenarios. So, for example, there are scenarios like net zero 2050. So, which is there from NGFS. So, when we talk about those scenarios, so then those scenarios have got target of achieving net zero by 2050. Then what will happen? So then that gets addressed there. So here in these RCPs, there is no net zero target here as such. So these RCPs are meant for this, and then we arrive at that when we would be able to achieve Paris Agreement, when we will be able to achieve 1.5 degree, 2 degree, or 3 degree, or 4.3 degree under different scenarios. But under NGFS, there is one scenario like net zero 2050, which has got target of 2050 as the net zero, and then what will be the impact of physical and transition risk under different under that scenario.
Okay, sir.
Okay.
Sir, I have a query.
Yes, sir.
Actually, does bank used to follow this? They used to consider the ESG report published by the corporates for lending.
Yes.
They used to consider that.
Yes. So banks have started considering that. Okay, so not only that, so banks have started also considering BRSR report also, then sustainability report also, so and then integrated annual report. So there are different types of reports which generally comes from corporates, especially from listed corporates. So they can be either integrated annual report or general annual report. So in general annual report, you will not find that much stuff, but when it comes to integrated annual report, so they have got a lot of sustainability related things. Then there are some corporates which publish their own sustainability report, and in their own sustainability report they also give mapping of different reporting standards and requirements. For example, for TCFD, GRI, BRSR, so they give those. And for BRSR, so there is one particular XML file which every corporate has to upload. So banks use that data also while conducting any ESG assessment of any corporate.
And does any incentive used to be provided for if a company is having a good ESG points or something?
Sir, not as of now from ESG, because see, ESG, again, my personal view. So ESG overall is a very vague concept. So it is not leading us to somewhere. So what banks generally do internationally and in India also, some banks have started doing some test cases on that, is linking the rate of interest to achievement of sustainability related parameters. While arriving at sustainability related parameters, so they use certain KPIs, key performance indicators, or sustainable performance targets. So emission reduction is one of those parameters. So if there is certain emission reduction, so the rate of interest gets reduced by certain basis point. But if it is not achieved, then it may also increase in by those basis points. But again, there are certain international use cases wherein the incentive has been linked to certain ESG ranking of that customer. So what you told is also correct. So for example, if someone achieves A ranking under MSCI, so they will be getting certain incentives. So those kind of incentives have also come up. But now slowly people are moving away from these kind of incentives to more material kind of incentives. For example, impact on emission related or water related. So how much percentage of water they are able to reuse. So or zero waste related. So those kind of parameters are now getting more considered as compared to something linking to overall ESG, wherein the overall impact is not getting quantified anywhere.
So do certain KPIs are there, like in terms of evaluation of individual or client's performance or something on sustainability?
Yes, sir. So if you go to ICMA website, International Capital Market Association website, so they have got a list of sector-wise KPIs. So they have given it from bonds point of view, and that is applicable for loans also. So for different sectors, which are the different KPIs which can be used, so are given there.
Okay, thank you, sir.
Sir, Alok this side. Sir, my question related to sustainable finance. I have a confusion. What I am getting about sustainable finance, if any investor, if anyone is doing investing in any company who has robust ESG system. Yeah, if any investor is investing in any company who is working like manufacturing some sustainable product. So this is sustainable financing, yeah, something else.
So see, so sustainable is very broad term. So it can lead to green finance also, social also. So in fact, social related financing is also called sustainable financing. Okay. So for example, when as a bank we give loan to vendors, or we street hawkers, or to women entrepreneurs or self-help groups. So that is also considered as social, and social also comes under sustainable. Okay. So by sustainable, we mean whatever is green is also sustainable, whatever is social is also sustainable. So that's the basic definition of sustainable. Again, what the earlier gentleman was asking, so that was so there is finance which is related to certain key performance indicators. So that is known as sustainability linked loans. So then that is another category, and that can be also related to green or social or other aspects related to customers. So again, so it all depends upon the type of transaction which is there. So it can be green also, it can be in fact climate also, transition can also be sustainable finance, and overall so everything is covered under sustainable finance. So not only sustainable products. So for example, if there is a steel company which is implementing something which will be reducing the intensity of that steel company. So if the finance for that machinery would also be considered as sustainable finance, and that will be coming under transition finance. Okay.
So what I'm getting, if industry, any company is working on sustainability product like project, if they are working for the solar project, decarbonization, if they are doing some innovation so that reduce their energy hazardous waste, this is sustainable financing.
Yes, yes, yes. So not only this, so sustainable is again a very big word. So social is also a part of sustainable financing.
Okay. Okay, sir.
So, no more questions from the side of the participants?
I have one more question, sir. If I talk about the banking sector, then if biodiversity loss is a material issue for banking sector, then what type of initiative banking sector is taking for the mitigation of that, like for biodiversity loss?
Okay, so see, the guidelines related to biodiversity loss related has come up recently only. So it has come up with the meaning of Task Force on Nature Related Financial Disclosure Guidelines, TNFD guidelines. Okay, but without that also, so there were project related evaluation which was happening earlier, and banks were aware of that aspect. Okay, and that was a part of credit decision process. But now that has been more formalized, and moving forward, that will be more integrated to the disclosure related requirements. So by formalizing this, what I mean to say is that banks have started now doing environmental social due diligence. Okay, so as a part of their project loan, and this biodiversity related risk also gets covered as a part of that. And some banks like us, in fact, we have developed a special biodiversity nature risk assessment template. Okay, and there are international some free and some paid databases. So paid databases like IBAT, and free frameworks and databases like Google Earth, IUCN List, and LEAP framework. So using this, we have just started doing something on a pilot basis. But moving forward, so most of the bigger project loans, and especially for project loans in highly vulnerable areas, so this will be one of the key factors at the time of decision making process.
Okay, sir. Thank you.
Thank you so much, sir, for such an interesting session which we had today. Dear participants, our second session for the day would start after the break of 5 minutes.
Right.
Kindly join at 7:40 via the
Thank you.
same. Thank you so much, sir.
Thank you, Deepak sir.
Thank you.